Welcome back to Iron Financial, the show where we forge stronger portfolios by putting market narratives under extreme pressure.
I'm your lead analyst.
And I'm your market skeptic. You know, today we are dragging StubHub directly into the forge. And let's be crystal clear about this. The stock didn't just have a bad day. It didn't just fall, it cratered. We're talking about a catastrophic plunge that is all of Wall Street asking one simple fundamental question. Is this company built on a foundation of solid iron, or is it a house of cards that just got hit by a hurricane?
To figure that out, we have to do what we always do. We run the numbers, we inspect the blueprint, and we search for the cracks. And our entire analysis today begins with one single brutal number.
$10.15. Just let that sink in for a moment. That is the price per share after the absolute floor gave out. Now remember, this is a company that had its IPO with a massive story, a huge promise of total market dominance in the ticketing world. A number like this, well, it isn't just a dip. It's not a correction. It is a brutal, final-sounding verdict from the market. This single number represents billions, with a B, in incinerated shareholder value. It all happened incredibly fast, it happened violently, and now every single investor left holding the bag is asking themselves two very simple questions. How did this happen? And more importantly, why?
And that really is the billion-dollar question, isn't it? My job here is to look at a headline like this one from Guru Focus and ask what really went wrong. We're not talking about a minor miss. This isn't a rounding error on revenue or some slightly soft guidance for the next quarter. Look at the word they used, plunge. That word, it signifies a fundamental break in the entire story the company was telling investors. Investors were sold this grand narrative of a high-growth, cash-gushing, profitable enterprise, and then reality came along and delivered a haymaker right to the gut. I mean, honestly, this is the oldest story on Wall Street. It's promise versus performance. And in this case, the market delivered a swift and completely merciless verdict.
That's exactly right. And to truly understand why this structure failed this critical stress test, you have to go back to the beginning. You have to look at the architectural plans. Before we start sifting through the wreckage, we have to analyze the blueprint that StubHub's management so successfully sold to investors. See, this isn't just about what went wrong in one single 3-month period. It's about understanding the foundation they claimed they were building all along. We need to examine every single piece of their argument, every load-bearing claim they made, to see if the materials were ever really solid to begin with, or if maybe the cracks were always there, just hidden beneath the surface, waiting for the pressure to build. Okay, so let's dive right into that blueprint. This here is taken directly from their Q3 2025 investor presentation. So this isn't speculation, this is the official story from the company itself. Just look at the key highlights. They are painting an absolute masterpiece of corporate execution. They're deleveraging the balance sheet. They're gaining market share. They are locking in these critical partnerships like their exclusive MLB deal. This slide right here, this is the bull case in a nutshell. It's a compelling story about a company building immense scale, fortifying its financial structure, and securing a dominant future for itself. This is the bedrock they wanted you to believe in. But the real question is it bedrock, or is it just a really good sales pitch?
So let's break down that first major point they make, the one about the balance sheet, because frankly, it is critical to the entire bull argument. What they're talking about here is structural integrity. The moment they went public, post-IPO, they took a huge chunk of that cash and immediately paid down $750 million in debt. That is a massive, decisive move. Now, functionally, what does that do? Well, it saves them about $75 million a year in cash they would have otherwise had to spend on interest payments. So in construction terms, what they did was remove a colossal amount of dead weight from the superstructure, and in doing so, they reinforced the financial core of the entire building. This is exactly what responsible capital management is supposed to look like. They were, by all appearances, forging a stronger, more resilient balance sheet from day one.
And this slide here, this explains the engine that's supposed to power the entire enterprise, an asset-light business model. Now, what does that actually mean in plain English? It means StubHub doesn't own the stadiums. They don't employ the athletes or the artists. They don't have to build massive capital-intensive factories to produce anything. They are a digital marketplace, a pure intermediary that connects a buyer and a seller and takes a cut. This design is supposed to be incredibly efficient. It's built from the ground up to convert revenue directly into free cash flow without the heavy drag of massive capital expenditures. It's meant to be a cash-generating machine by its very nature, which is precisely what a company needs to both pay down debt and reinvest in future growth. Of course, the all-important question remains, is it actually working?
And this number right here, this is management's first and loudest answer to that very question. It's an argument of sheer brute force scale. $9.4 billion. That's their trailing 12-month gross merchandise sales, or GMS as you'll hear it called. That is the total dollar value of every single ticket that was sold on their platform in the last year. This number, you have to understand, is the main load-bearing pillar of the entire company. It's the proof of their market position. You simply do not get to a number north of $9 billion by accident. That represents dominant global market power. It's an undeniable sign of scale.
But of course, a massive pillar doesn't mean a whole lot if it's starting to crumble. A skeptic would immediately say that big numbers are great, but are you still growing? And this number, 19%, is management's immediate rebuttal to that question. 19% year-over-year growth on that already massive GMS number. So what this tells you is that the structure isn't just large, it's actively and rapidly expanding. This is the kind of growth story that gets institutional money really excited. It tells you they aren't just sitting back and defending their territory, they are on the offensive, actively taking market share and expanding the walls of the fortress.
And finally, we get to the capstone of the entire bull case, profitability. 14% adjusted EBITDA margin. Now, for investors, you should think of EBITDA margin as a key indicator of a company's core operational profitability before you get into all the accounting and tax complexities. It shows that the massive scale we just saw and the rapid growth we just talked about are actually translating into tangible profit. It's the ultimate proof that the asset-light model is working exactly as it was designed. This suggests they aren't just chasing revenue for the sake of headlines, they claim they are growing profitably. So when you put it all together, the blueprint is actually very simple. A massive, growing, and profitable market leader. On paper, it looks absolutely perfect.
And this chart is the perfect visual representation of that perfect story. Take a look at the trailing 12-month GMS. Quarter after quarter, from early 2023 all the way to Q3 of 2025, it is just a steady, relentless upward march. Each one of those bars looks like another layer of steel and concrete being added to the skyscraper. It's the kind of chart that just screams consistent execution and predictability. It's designed to build trust. But, a chart is just a picture of the past. It looks solid, I'll give it that. But a beautiful blueprint doesn't tell you how a building is going to perform in an earthquake. And as it turns out, the ground just started shaking.
Exactly. That blueprint looks fantastic hanging on the conference room wall. It's strong, it's growing, it's profitable. I mean, who wouldn't want a piece of that action? But here's the thing. A blueprint is a promise. It's a plan. It is not reality. And the market just conducted a real-world, full-scale stress test on this company called the Q4 earnings report, and the entire structure just buckled under the pressure. So now, it's time for us to put on the hard hats, get past the glossy presentations, and inspect the damage up close. It's time to find the cracks in the armor.
You know what, let's just cut right to the chase. All that talk of blueprints and solid foundations and asset-light models, it's completely meaningless if the building collapses at the very first sign of a storm. So what broke? Where is the precise point of failure that caused this catastrophic collapse in the stock price? Because this wasn't a vague feeling, it wasn't a subtle shift in market sentiment, no, it was a single, devastating number that completely shattered the entire narrative the company had spent years so carefully constructing.
And here it is, negative $1.56. That was their earnings per share, or EPS, for the fourth quarter. Let's be absolutely clear about what this means. This isn't a miss, this is a disaster. After months and months of showing off their 14% adjusted EBITDA margin and talking endlessly about profitable growth, they turned around and delivered a massive, shocking loss. This right here is the first undeniable gaping crack in the foundation. It directly contradicts and, frankly, invalidates the entire profitability pillar of their bull case. A number like this doesn't just raise a few questions, it sounds a 5-alarm fire bell for the entire market.
And the damage report here from MarketBeat lays out the brutal, simple logic of what happened. You have the EPS coming in at negative $1.56, you have revenue at around $449 million, and you have the market's reaction, a plunge. The cause and effect here is direct, and it is merciless. That EPS number was the trigger. It screamed to the market that something is fundamentally broken in this company's ability to convert its $9 billion in GMS into actual profit for shareholders. The whole efficiency story, that whole asset-light model argument, just got blown to absolute pieces by one single earnings report.
And listen, this isn't just about one bad quarter. According to third-party analysis from GuruFocus, there were warning lights flashing on the dashboard even before this disaster. They flag challenged financial strength. And even more alarmingly, they point to the Altman Z-score. Okay, hold on. Let's back up. What exactly is an Altman Z-score, and why should anyone listening right now care? It's not a metric you see every day. The Altman Z-score is a formula that was developed specifically to predict the probability that a company will go into bankruptcy within 2 years. You can think of it as a financial health EKG for a company, and a low score, which StubHub has, indicates potential distress. So when you see that plus one severe warning sign and one medium warning sign, you realize these aren't small issues. These are systemic red flags suggesting the problems run much, much deeper than one bad earnings miss.
Okay, so the Q4 numbers are severe. There's absolutely no spinning that. And the warning signs from the Altman Z-score are a legitimate cause for deep concern. So this brings us to the absolute core of our analysis today, the ultimate financial stress test. On one side, we have the company's pristine blueprint, their promise, and on the other, we have its actual disastrous performance. It's the architectural rendering versus the earthquake footage. We have to put them side by side and determine, right now, which one tells the true story about the future of this company.
So the crucial debate is right here on this slide. On the left, you have the bull case I laid out earlier. Proactive debt reduction, strengthening the balance sheet. You have an asset-light model designed for cash conversion. And you have undeniable 19% year-over-year growth. These are foundational facts. A single bad quarter doesn't just erase billions in sales or a fortified balance sheet. It's a setback? Yes, but it's not a demolition. A setback? Are you kidding me? Look at the right column. That's not a setback, that's a system failure. A negative $1.56 EPS doesn't just weaken the strong cash conversion argument, it completely incinerates it. A plunge in the stock isn't just market noise, it's a massive collective vote of no confidence from everyone. And that challenged financial strength warning, which is backed up by a bankruptcy predictor, suggests this isn't a one-time event, but a symptom of a much deeper disease. You can't just ignore the fire raging right in front of you by pointing at some old blueprints.
And that brings us to this massive disconnect, right here. The market price is $10 and change, but the consensus analyst price target is more than double that, at over $21. So who is wrong here? I mean, are the professional analysts who model this company for a living just completely blind to the risks that we just laid out? Or is the market, in a fit of pure, unadulterated panic, creating a massive overreaction and maybe a generational buying opportunity? That is the entire debate. The analysts, they're looking at long-term valuation metrics. Guru Focus points out that the price-to-sales and price-to-book ratios are near one-year lows. On paper, that suggests undervaluation. But those ratios are all backward-looking. The market is betting that the entire narrative is broken and those fundamentals are about to get much, much worse. The analysts are betting the company rights the ship. The market is betting it sinks.
Which leads us finally to our verdict. We've examined the company's pristine blueprint from Q3. We've inspected the deep, ugly cracks revealed in Q4. We have weighed the promise against the brutal performance. So, what is the true structural integrity of StubHub? Is this a deep value opportunity to buy a solid asset that's been unfairly punished by a panicked market? Or is it a classic value trap, a crumbling structure that looks cheap right before it collapses entirely? It is time for the iron verdict.
All right, let's summarize the bull case one last time. The reasons for reinforcement are clear, and they are data-driven. First, the GMS growth engine is a proven powerhouse. You do not facilitate over $9 billion in sales without a dominant, market-leading platform. That is a fact. Second, management has been proactive, reinforcing the balance sheet by paying down a significant amount of debt. That's also a fact. Third, the asset-light model, despite the Q4 shock, is still fundamentally designed for efficiency and cash flow over the long term. Fourth, look at that institutional ownership, nearly 75%. The big, so-called smart money is still heavily invested here. They haven't all fled for the exits. And finally, as we discussed, the valuation metrics are sitting at historical lows, suggesting the stock may be deeply undervalued if, and I'll grant you it's a big if, management can regain control of the bottom line. The bull argument is that the core structure is still sound. It just suffered some cosmetic damage.
But the signs of collapse are just impossible to ignore. The Q4 EPS miss wasn't a hiccup. It was a devastating blow to the credibility of management and their entire profitability story. The market's reaction wasn't a dip, it was a plunge, a clear signal of lost faith. The external warnings from Guru Focus, especially that Altman Z-score pointing to the stress risk, are a massive red flag waving in your face. And perhaps most importantly of all, the narrative has been broken. You have to remember, trust is the single most valuable asset a company has with its investors, and that trust has been severely damaged. Rebuilding it will be a long, brutal, uphill battle. The Q4 report wasn't just a crack. It was a seismic event that shook the entire foundation to its core.
So we are left with this final critical question for your portfolio. Is the wreckage we're seeing today evidence of a fatal structural flaw in the company's very design? Or is this simply the chaos of construction, the dust, the noise, the fear that always comes with building a true landmark, which is now available at a deep discount? The bull case rests on the power of that GMS engine and a fundamental belief that the blueprint is still sound. The bear case argues that the engine is sputtering and the blueprint is completely worthless in the face of a failed stress test. The evidence is on the table. The final call, as always, is yours. That's our analysis here at Iron Financial. Do your own diligence and forge your own path.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.